Well, according to a briefing presented to Pakistan's National Assembly Standing Committee on Finance, the domestic economy could face losses of up to $68 billion due to the West Asian conflict. Economist Ali Salman outlined three potential scenarios, warning that even a short-duration conflict carries significant economic consequences. In the current scenario, based on 51 days of the war, Pakistan could see annual losses between $10 and $14 billion. This includes higher oil import costs, reduced remittances, falling exports, and increased freight charges. Inflation in this case is expected to range between 10 and 12%. If the conflict persists for 3 months, the impact could deepen. Losses may rise to between $24 and $32 billion annually. Monthly oil import costs could increase by $1 billion, while remittances and exports may drop sharply. Inflation in this scenario could climb to 13 to 15%. In a severe scenario where oil prices surge to $150 per barrel, the economic damage could reach between $50 billion and $68 billion annually, equivalent to roughly 17% of Pakistan's GDP. Monthly losses in this case could hit $5.7 billion, with remittances falling by up to 40% and exports nearly halving. Inflation could spike as high as 17%. Now, this conflict, which began on the 28th of February, has already disrupted global energy flows. Prime Minister Shehbaz Sharif noted that Pakistan's weekly oil import bill has already jumped sharply. Despite these risks, lawmakers raised concerns over the government's fiscal management. The Finance Ministry pushed through amendments allowing greater control over debt office appointments and drawing criticism from committee members. Officials also acknowledged that Pakistan's debt to GDP ratio remains above statutory limits, underscoring broader economic vulnerabilities at a time of heightened external pressure.